Gold is approaching a critical decision point, and what happens next could trap thousands of retail traders. This is where institutions usually make their biggest moves quietly, strategically, and with precision. In this breakdown, we'll analyze gold using pure price action, liquidity theory, and institutional smart money concepts, exactly how professional traders read the market behind the scenes. On the 1-hour time frame, gold clearly shows a bearish market structure. We see consistent lower highs forming a signature of institutional distribution pressure. This lower high near the 4,825 region shows where sellers regained control, rejecting price from premium zones. Then price breaks structure downward. This is a break of structure, confirming bearish continuation and institutional selling pressure. Price forms a new lower low, reaching into discounted territory where buy-side liquidity begins to accumulate. This red supply zone around 4,725 to 4,735 represents institutional selling interest where large positions were likely executed. Notice how price retraces into internal supply before continuing lower, a classic continuation pattern. Equal highs form liquidity pools, areas where retail traders place stop losses. Institutions target these levels before reversing price. Below, this blue demand zone represents strong buying pressure, likely where institutions accumulated positions. This wick sweeping equal lows is a liquidity grab, institutions collecting stop orders before reversing price. Immediately after the sweep, price reacts aggressively upward, confirming demand absorption. Price now consolidates within a tight range. This is where manipulation often occurs before expansion. Institutions distribute at highs, accumulate at lows, and manipulate in between. That's the real story behind these candles. Repeated rejections from supply indicate persistent selling pressure dominating this market. As long as price stays below supply, the institutional bias remains bearish. But to understand what's happening right now, we need to zoom deeper into execution level detail. Now let's move to the 15-minute time frame where institutional footprints become clearer. This bullish push shows short-term buying strength emerging from the demand zone. This internal break of structure confirms temporary bullish continuation. Price begins consolidating again, a sign that liquidity is building for the next move. Equal highs here are magnets for price. Institutions often push into them before reversing. This zone acts as intraday demand, holding price above bearish continuation. Notice how candles shrink, momentum is slowing, suggesting absorption. Fake breakouts like this trap retail traders into poor entries. This wick is a classic manipulation, grabbing liquidity before reversal. If price continues higher into premium zones, selling opportunities become extremely attractive. Sell setup logic: wait for price to sweep liquidity into this 4,710 to 4,725 supply zone. Look for strong bearish rejection, confirming institutional selling pressure. Entry price 4,715 after confirmation candle closes bearish. Stop loss 4,738 above liquidity highs to avoid premature stop outs. Targets TP1 at 4,680 and TP2 at 4,660, delivering strong risk to reward potential. BUY setup logic: if price returns into deep demand near 4,660, buyers may step in again. Wait for bullish confirmation showing strong demand reaction. Entry price 4,662. Once bullish momentum confirms institutional buying. Stop loss 4,638 placed below liquidity lows to protect capital. Targets TP1 at 4,695 and TP2 at 4,720, offering strong upside continuation potential. Professional tip: always trade from premium to discount zones. Never chase price in the middle. Professional tip: liquidity is the fuel of the market. Wherever stops exist, price eventually moves. If you want more institutional level breakdowns like this, subscribe now, and in the next video, we'll track whether gold respects supply or breaks structure entirely.